Okay. I think I'm on now. Okay. Can you hear me now? Awesome. I told y'all this is gonna be I those who saw on Facebook, I have no idea what I'm doing. So we'll start that over. Welcome back to Lean on Success, where process improvement is self improvement. My name is Ben. I'm a Lean Six Sigma Master Black Belt, and I am attempting to go live. I have never done this before. I think that's going to be painfully obvious to everybody here. Thank you to Colonel Buckshot. You've been helping me realize that nobody can hear me. So thanks to you, everyone can hear me now. So shout out to Colonel Buckshot. Thank you so much for joining. You are, as far as I know, the very first person that's watched me do this live. So I hope you have very low expectations. All right. So what I'm going to do is I wanted to take the time to do an economic update on the month of July. So all of the things that happened in July, a lot of things happen as far as inflation reporting. Of course, we get a monthly inflation report. We got a jobs report. We're going to go over that. Also, the Fed had a meeting late in July, actually last week. And also, we had an updated GDP report. We're going to go through all of that. We're going to talk about the housing market a little bit. We're also going to talk about the used car market. And then I'm going to put together my analysis and give you conclusions on what I think all this means and where we're headed in the future. So that's a lot on our agenda to cover. So I'm just going to go ahead and jump right in. And we're going to go ahead and take off here. All right. So again, want to present an economic update for the month of July. We're going to start with inflation. Now, the inflation reports came out and the government basically said, hey, good news. Inflation is down to 3%. We're really close to that 2% target that Jerome Powell's been talking about all this time. And of course, I think the government's a damn lie. So I had to go into the numbers and figure out for myself what the heck is going on here. So you can see here that this is the overall inflation. We're at 3%. Now, when you look at food is at 6%, right? So food actually went up by 6%. And these are, again, CPI looks at year over year. So how much higher do these things cost than they did at the same month last year? Food went up 6%. Energy went down by 17% year over year. We're going to talk about that in a minute. And the core inflation, which we're also going to cover in a minute, was at 5% according to the most recent CPI reporting. Right now, again, a lot of you, and I see Colonel Buckshot kind of saying, well, wait a minute, how did energy go down by 17%? And gas just recently jumped up by 20 cents a gallon. Well, that's part of the damn lie that I'm talking about, which is the way that these numbers are reported. It can be very misleading when you're looking at what's happening today in a short-term comparison of a couple weeks ago or a month ago versus what happened a year ago. So we're going to get into that here in just a minute. But the one thing I want to point out here is that when you take away food and energy from the overall inflation reports, the actual inflation rate is about 5%. So that's something that's really telling about the fact that, well, inflation, you may say, is 3%, but we've seen this huge downturn in energy costs that we know is pulling that number down further than what we really are feeling. That core inflation is really what we're feeling. That's at 5%. So this is, I want to take a minute to talk about something called common cause versus special cause. So when we see fluctuations in data, there are two main causes for that, or there are two main ways that we determine or try to figure out how those fluctuations occur. The first one is something called common cause. Okay. This is something that's a predictable cause for observed fluctuations. So for example, if my water bill goes down during the week and goes up during the weekends, then what I know is that if it's higher on the weekends than it is during the week, there's nothing special about that because we do a lot of our clothes washing on the weekends. So we're running that washing machine more. We're spending more time together as a family in the house. We may be running water more often to water our grass or to cook dinner and so forth. So our weekend usage typically is going to be higher than weekdays because we're not here at the house as much. My wife works away from the house. My daughter's in school, normally during regular hours, and there's not as many people here during the week. But weekends, we're here more, we use more water. Now, what I also could tell you is 2 weeks ago, my water usage tripled what it normally was in one day. We had a Saturday, we actually were out of town, but my water usage went up triple what it normally does on a Saturday, even though we weren't even at the house. Well, that's what we call a special cause. What happened was the people who take care of my lawn, I suppose, were cutting the grass near my house. They accidentally nicked a pipe in my sprinkler system, and it caused a pinhole in my sprinkler system to leak. And so that had been leaking for a long period of time. That caused my water bill to go up by about $10. That's what we call a special cause. That's something that's unexpected, unpredictable, that's causing an abnormal fluctuation, right? Now, when we look at the energy situation, this is what I call a classic case of special cause. Energy's down 17%. There is nothing that's predictable about that. There was a special cause that happened. So if energy's 17% less than it was last year, what could have happened in the last 12 months that would have caused energy to go down like that? Well, there's a little something called the Russian invasion, right? Russian invasion started in February of last year. And if you remember, there was an embargo on goods out of Russia as part of the solidarity that the United States and other members of the world were showing, where they were no longer purchasing Russian oil. And because there was an embargo on Russian goods, one of the chief ones being oil, that caused oil energy prices to go up significantly because that caused a disruption in the supply chain. Now, what we see is this 17% downturn that's represented here by this arrow. That is only the fourth time since the Great Recession that we've seen such a dramatic decrease in oil prices. In this case, we know that there was a big run up after the last recession, right? We had a huge drop because nobody was driving anywhere. We saw a huge drop in oil prices after during the COVID recession. We then see that as we started to get into 2021 and 2022, the oil prices started to stabilize after the world opened back up. So we saw that oil prices started to return back to what the levels were in the 2 years leading up to the pandemic. Then we see that as the Russian invasion occurred, oil prices skyrocketed. So really what we're seeing is a normalization of the supply chain for oil and energy prices that's causing us to come back down to the levels that we were at prior to the invasion. So that 17% decrease we're seeing is the supply chain kind of returning to its normal levels after the invasion occurred. So this severe drop in energy prices that's driving that 3% inflation number, we know that's special cause. So that means that we don't need to put too much stock in that 3% number because we know that it's being artificially driven by a special event that occurred. And this is only the fourth time in the last 15 years that we've seen such a dramatic decrease in oil prices. And in all these cases, it was kind of unpredictable, right? So, let's stick a pin in that and let's think about, okay, 3% inflation is not the real inflation, right? So going back to this again, we see that the less food and energy, what we call the core CPI, is around 5%, right? Now, we also call core inflation sticky CPI, right? Because it's a little more stubborn and it doesn't have as much volatility in it because it doesn't include food and energy, which are two of the most volatile commodities as it relates to price fluctuations. Okay. We all remember what happened with eggs during the pandemic, going up to $5 and $6 a dozen. And now they're returning back to near levels they were before the pandemic started. Food is a very volatile commodity from a price standpoint. And we know that gas is very volatile as well. All right. So we see that right now, core inflation is over 5.5%. That's the highest that it's been since 91. Right. So since the recession, the Gulf War recession of 91, we're at a 30-year high for core inflation. right? We're feeling that. I know all of you are feeling that. I know that I'm feeling it. Okay. I joke with my wife all the time that everything went up since the pandemic started. Everything went up except my salary. All right. Let's look at unemployment now. So we took a look at inflation. Now let's take a look at employment numbers. So unemployment remains flat at 3.6%. So I've reported in previous videos, this is historically low. Well, we don't usually see employment this low. In fact, since January of 22, unemployment rate has been below 4%. That's 18 months in a row that we've seen sub 4% unemployment. That is the longest streak of sub 4% unemployment since the sexual revolution in the 70s, when we saw women start to enter the workplace en masse. So we're talking about a 50-year situation of a very long streak of unemployment. Now, if something only happens once every 50 years, again, that's special cause. There are specific drivers that's causing these rates to be where they are. And we know that that's not sustainable for the future. We know that's not sustainable. Now, part of what I want to talk about here with this is what's called the participation rate. This graph is essentially showing the percentage of people that live in the United States that are ages 16 and older that are actually in the labor force. Now, to be in the labor force, you either have to have a job or you have to be actively looking for a job. Now, it's a little bit difficult to see here, but what you can see is that, again, when we look at the sexual revolution starting in the 60s, you see that there is a significant run up in participation rate. Why? Because prior to the 60s, we were existing primarily in nuclear families. You had a male breadwinner that would go out to work in the factory or the office, wherever he worked, and the wife would stay home with the children. So you had one income families where the man went out to work, the wife stayed home. So your participation rate was down in the upper 50s because there was a large percentage of women that were not in the workforce because they were home with the children. We know that dynamic started to change starting in the 60s, and that's why you start to see this participation rate start to climb pretty steadily, where it peaked around the mid 90s, right before the dot-com boom. So what we see is that women are starting to enter the workforce. We starting to see more two-income households, and we started to normalize both men and women working in the workplace as a society. And so this participation rate, or the percentage of adults 16 and older that are in the workforce. Now, what you see here is that when the Great Recession occurred, there started to be a significant dip in that participation rate. We know that unemployment was rampant. The world kind of changed forever as a result of that. And we also need to remember 2008, a lot of your baby boomers had reached or were reaching retirement age. So the Great Recession kicked off around the time that the oldest baby boomers, who were born in the mid 40s, were starting to go into retirement. And so on top of the unemployment and the employment industry kind of resetting itself, that coincided with systematic retirement. And so now you have adults who are alive but are in retirement and are not working. So your participation rate goes down because the percentage of people in the workforce goes down, or was going down. That continued to go down until middle of the last decade, 2013 or so. We see kind of a stabilization around the 63% range. So things started to kind of stabilize. Retirees are still going out, but because the economy was growing, we were able to kind of replace those workers, and we started to create jobs at the same rate that the retirees were leaving the workforce. So we kind of saw a stabilization in participation rate. Then, of course, COVID happened, and this sharp dip you see here is something that we call the Great Resignation. You had a lot of people that changed careers, a lot of people that decided to retire early because of what was happening with COVID. And so you saw this tremendous dip in participation rate because you had a sudden exodus, unexpected exodus from the workforce as well as a lot of businesses that went out of business and a lot of people that had to find new jobs. So this is effectively, when you hear people talk about the labor shortage, what they're talking about is there was a sudden and unexpected departure of laborers out of the workforce. And based on the participation rates where we were prior to the pandemic, we're still only at about 62.5%, which is a shortfall of, a couple million people. So from a pre-pandemic standpoint, we're technically still in a labor shortage because of how there's still a gap between the current participation rate and where it was prior to the pandemic. So let's keep that in mind. Let's stick a pin in that and figure out, okay, something's going on with the labor shortage. How are companies and the government responding to that? We're going to talk about that in just a minute. All right, so now let's get into GDP. All right, now just to give you a quick review for those who are not familiar with what GDP is going to go give you a quick definition here. So GDP is the sum of all goods and services produced by a country over a given time period. Now, this is typically measured quarterly. So what happens is that we will look at, the latest report will show, we look at all of the goods and services that were produced in April, May, and June of this year, and we compare that to the same volume of the same goods and services that were produced in the first quarter of the year, which was January, February, and March. Now, this is important because GDP is one of the primary indicators that we are experiencing a recession. Prior to 2008, the economic definition of a recession was when an economy had a negative GDP 2 quarters in a row. In other words, there was a contraction or a reduction in the amount of goods and services that were produced over 2 consecutive quarters. All right, so GDP is a strong indicator of the health of our economy and whether we're in a recession or not. Now, this goes back to approximately the last 4 years and is showing what the GDP was quarter by quarter over the last 4 years. Now, you can see that we have here the pandemic recession here, the COVID recession. You see that GDP went negative in Q1 and Q2 of 2020. Then it came back with a vengeance and went on kind of a nice rally starting in third quarter of 2020 all the way up to 2021. You have what I call the secret recession. You notice here, last year, the first 2 quarters of last year, we actually had negative GDP. So from a classic definition standpoint, we experienced a recession last summer. Now, why was no one talking about that? Well, that's because in 2008, the definition of recession was expanded and became a lot more vague. Well, you got to have negative GDP for more than a few months, and you need to see disruptions in multiple things at the same time. You need to see disruptions in manufacturing. You need to see disruptions in your employment rate, et cetera, et cetera. So because even though GDP was going negative and our ability to produce goods and services went down 2 quarters in a row, we've had such a strong jobs market that the consensus in the industry was, there's not a recession. What are you talking about? No, nobody's going to talk about that. We're not in a recession, right? So we see that we had what I call the secret recession that happened in the summer of last year. But as you can see, the last 4 quarters, we've actually had a positive GDP. The economy and our ability to produce goods and services has been growing fairly steadily since the third quarter of last year. Now, last quarter, GDP went up by 2.4%, right? So that's obviously a good sign. That is an indicator that the economy is strong, that the economy is growing, and that we are not in a recession or headed towards a recession, right? Good news, right? Again, we'll talk about that a little bit more here in just a minute. Let's talk about the Fed. Everybody loves to beat up on Jerome Powell and talk about the Fed. Let's get into that. Now, again, quick review. The Federal Reserve is a central bank that is funded by the government, but acts independently from the government. That's very important, especially because we see that there's a lot of pressure that's being applied by the government to the Fed to lower interest rates and to create more money and more opportunities for people, right? Now, the Fed has authority from the government to buy and sell certain assets and to raise and lower interest rates. Now, why is the Fed authorized to do this, and why do they do it? So the Fed, these are two of the primary levers that this central bank uses to respond to any type of extreme outliers from an economic standpoint. Okay, now let's give you an example. During the pandemic, the economy tanked. I just showed you the GDP numbers. The world was shut down. A lot of businesses closed. People weren't able to work. So what the Fed did was, okay, we're going to go ahead and do a consumer stimulus, right? Them stimmy checks, right? Them stimmies hit. We're just going to throw a bunch of money at people to try to get the economy going again because people aren't able to work. There are a lot of people have lost their incomes, and people need to be able to have income to live. So we just threw a whole bunch of free money out there. I think to the term of $1 trillion or so worth of consumer stimulus. Also, there was bank stimulus. So all of the interest rates were lowered to near zero as a way to make it easy for the banks to lend money to each other and to free up money, therefore, for businesses to be able to stay afloat during the time that they were going through economic downturn when people didn't have income to buy things. So there was a stimulus to lower interest rates that made it easy and cheap for people to borrow money in order to stay afloat, and businesses as well. Also, there was, I call it business stimulus. The Fed started buying up a bunch of assets. One of those primary assets were mortgage-backed securities. I've talked about this in a previous video, where basically mortgage-backed securities are, they're kind of like stocks that are comprised of mortgages on homes that can be bought and sold based on the value of those homes going up, as well as the performance of those mortgages. So if you have good mortgages where people are paying them on time and not defaulting, that gets a higher rating, and you can sell that block of mortgages to different private equity investors as an investment tool. And so the Fed started buying up a whole bunch of these mortgage-backed securities. Now, what that did was that put a lot more money into the hands of the investors, hedge funds, private equity firms, banks, and corporations who were holding on to these. And that basically put money in their pockets to be able to continue to grow their business. Right. So there was a lot of stimulus. Right. Now, this is known as quantitative easing. It's basically saying, quantitative means a lot of parts, and easing means making things easier. The Fed is basically saying, look, we'll throw money at consumers, banks, and businesses as a way of loosening up the economy, right? The economy was stood still, was bound up tight due to the pandemic, the world being shut down. We want to relax the muscle by throwing money at it, right? That's essentially what the Federal Reserve did during the pandemic. All that was fine, well, and good. Well, the problem was, there's only one problem. Inflation started to kick our butts, right? Inflation started running crazy. Prices started going sky high. Everybody's got their stimmy money. Is basically 0% interest to borrow. And so what people are going to do when you lower interest rates, people are going to borrow money like crazy. There's so much money in the market. And so that inflated demand, combined with the fact that we had so many supply chain issues because of COVID. Again, a lot of our consumer goods come from China. Because China was shut down, we didn't have access to the raw goods and materials we needed for all the consumer goods that we consume. You have very tight supply. You got a lot of people with money burning up their pockets. That caused prices to skyrocket out of control. In fact, you could argue with a 5% interest rate is still indicative that prices are out of control, because again, that's the highest that inflation has been in 30 years. So we're still experiencing increases in pricing that if you're less than 30 years old, you've never even seen before. And so we had low supply, we had cheap money and high demand. So now the Fed says we have to do something about this inflation, right? So all the stuff I talked about in the last slide, where we're going to throw money at the situation to kind of loosen the economy up. Well, now the economy is going crazy, right? It's all over the place. So now what the Fed is saying, we need to now draw money out of the system to try to tighten the economy back up again. We got to get inflation under control. So now we're going to do something called quantitative tightening, right? So we were holding on to all these assets and buying up all these assets to put more money in the system. Now what we're going to do is start releasing and selling those assets back into the markets. And we're going to take the money from those sales. We're going to hold on to that money. We need to suck money out of the system, right? Inflation is high. We need to suck money out of the system. If we take people's money away, they won't be able to buy things, which will cause price demand to go down, which will cause prices to go down. For those of you who are fans of Coming to America, there was a scene when Semi went out and bought a whole bunch of furniture for the apartment, hot tubs and all this kind of stuff. When we know that the prince Akeem was trying to portray that he was just a poor person, but Semi was kind of blowing up the spot by buying all this extravagant stuff. And so the next day he makes Semi, they move apartments, they get rid of all the stuff, and he takes all of Semi's money away. And he says, without money, if you have no more money, you can cause no more mischief. That's what the Fed is doing. The Fed is taking, we're Semi, the Fed is taking our money away, right? If you don't have any more money, you can't cause any more mischief by driving up prices out of control. So they're selling assets to suck money out. And then they're also raising interest rates. So now it's not profitable or advantageous as it once was to borrow money. They're trying to discourage people from borrowing money because, again, they're trying to suck money out of the system. The less money that's in the system, the lower demand for consumer products will be, and the lower the prices will go, the lower that they will be able to drive inflation. That's the theory. Now, what we can see is with inflation still being at 5% on a core level, the Fed is still not really any closer to their 2% target. We're going to talk about that here in a minute. Now, last week when the Fed met, they decided to raise interest rates by another 25 basis points. Now, again, this is in response to GDP strong. GDP grew by 2.4%. Inflation still over 5%. Unemployment is under 4%, right? So the Fed is basically looking at, is the economy performing well enough to be able to tolerate higher interest rates, right? If we don't want to suck out too much money because we don't want to throw the economy into a recession again. But we've been doing all these hikes, as you can see here, since 2022. The Federal Reserve has been steadily increasing the interest rate, right? Tick by tick. Okay, trying to calm down inflation. But we got to watch out. Let's make sure that we don't tank the economy. Okay, GDP strong, and employment numbers look good. Inflation still high. All right, let's tick it up again. So they raised it another 25 basis points last week, right? Now, basis point is a 0.01%. So 25 basis points just means 1/4%, right? So now the base interest rate, I believe, is at 5.33%, right? Now that is the highest base funds rate since the dot-com bubble in the 2000s. It's even higher than where they stopped prior to the Great Recession, right? So we're looking at a 30+ year high for inflation. We're looking at 20+ year high for the funds rate. Okay, now just remember that. I'm going to stick a pin in that. I'm going to come back to that in just a minute. All right, so let's look at housing, right? Nobody can afford their house right now, right? My wife had been wanting to buy a new house for a couple years, but we looked at the prices and we can't afford it. So we got to stay where we're at. Now, the prices of houses that were sold, so the sales price of homes, despite what all of these, rabid wolves called, over aggressive realtors may be telling you on the street, prices for sold homes are actually down 7% year over year. Homes cost 7% less than they did this time last year, and it's down 13% from an all-time high, right? So this was the peak here, summer of last year, and you see that we're down 13% based on sales price. So the actual price that homes are going for is going down. Now, obviously, that's good for those of you who are in the market to buy a house, or are trying to buy your first home, or you want to move into a different home for whatever reasons, is now a little bit more affordable than it was this time last year, and more affordable than it was last summer. Now, the list price, however, so the amount of the prices that people are asking for homes remains pretty flat year over year, and that's still at an all-time high for our housing market. There are a lot of reasons for this. I'm going to go into this in a future video, but a lot of what we're seeing in the housing market is we have very stubborn sellers that are in good, overall, they're in pretty good financial positions. And so they're not incentivized to sell off their home. We're willing to wait and sit until they're able to find buyers. Sellers, generally speaking, are in a relatively good position in terms of trying to sell their homes because a lot of these sellers are sitting on very low interest rates. And so it's not as risky for them to wait to sell their home because they've got runway from an interest rate standpoint. So we're still seeing sellers being pretty stubborn with their list prices. Now, this one may be a little difficult to read, but when you look at pending home sales, so homes that are on the market, what a percentage of pending home sales year over year. What you're seeing is, of course, during the pandemic, everything plummeted because you couldn't buy a house because everybody was stuck in their homes. Then we saw when the world opened again, there was this rampant selling and home prices started to inflate and skyrocket out of control for about a year or so. But what you really are seeing, really since the third quarter of last year, there's been a significant and consistent downturn in the percentage of pending home sales year over year. What this is indicating to us is that, again, despite what some of these over-aggressive realtors may be telling you, the demand for new homes is drying up very quickly. We're going to talk about why in just a second. But if you see that list prices remain high, it's not just because there's low inventory. The real reason is that there's not any demand. No one's buying these houses, which is why they're staying on the markets longer and why we're seeing a year-over-year decline in the prices. Now, let's look at 30-year mortgage rates. Now, again, you see here, in the last year or so, we're seeing rates close to 7%. And that's the highest that they've been really since right after the dot-com bubble. They're even higher than they were prior to the great financial recession. So we're seeing pretty historic highs on mortgage rates. Now, we know that there's a correlation between the increase in mortgage rates and the federal funds rate being increased, right? Those two things are correlated. So as the Fed continues to raise interest rates, the rate to buy a mortgage is going to increase at the same rate, because if the banks have to pay 5% interest, they're going to make you pay 7 or 8% interest for a mortgage, because that's how they make their money, right? It's the interest arbitrage. Now, to give you a point of reference on the impact that home prices and mortgage rates are having, the month before the pandemic in February of 2020, the median sales price for a home in the United States was $325,000, and a typical interest rate you get at the time was 3.45%. That translates to a mortgage payment of about $1,450, right? That's what a typical mortgage payment would be for buying a home in the United States in 2020. Today, median sales price $420,000, interest rate is 6.8, which means you have a mortgage payment. The typical mortgage payment for a median house at a median interest rate is over $2,700. So the monthly cost of owning a home, this doesn't include insurance, any of the ancillary costs associated with a home. This is just principal and interest. Just the mortgage is nearly double what it was 3 years ago. It's increased almost 100% in less than 3.5 years. That's ridiculous. It's not sustainable. And we're going to continue to see a plummet of demand in home prices because people just can't afford it anymore. All right. So that's your housing market. Now, we're going to spend a few minutes to talk about the auto market. Right. So when we look at used cars and trucks, the good news is we are seeing a decrease in the prices of used cars and trucks by 5% year over year. That's good. Prices are coming down. But as you can see, based on this chart, we are still at near a historic high. Same thing with cars and trucks. The prices of cars and trucks just absolutely exploded after the pandemic. right? You had the chip issues, supply chain issues. People couldn't get their hands on these cars, and so the prices of them started to go out of control for new cars, which meant that because people couldn't get new cars, you had an exploded demand for used cars, which means used cars went out of control from a price standpoint as well. Now, however, when you look at total vehicle sales, we see that we had kind of a spike in sales in the year coming out of the pandemic, but you can see that there started to become a decline in demand, and it's pretty spiky. So we know there's some seasonality with that. What we're seeing is that sales volumes have been pretty spiky from one month to the next. It is starting to trend upward, but now that we're going into the fall season, I think we're going to see some downward spiking from a seasonality standpoint. And I'm not confident that we're going to ever get back to the pre-pandemic level of between 17 and 18 million vehicles a month. I don't think we're ever going to get there, not in any time in the near future, just based on the seasonality and the affordability that we talked about. Let's talk about the financial markets. This is not something that I cover very often, and I'm certainly not. I'm not an expert at any of this stuff. But I'm not. I'm not a financial advisor. I don't have any certifications in investments, or I'm not qualified to give investment advice. So I do tend to stay away, generally, but from talking about financial markets. But I think there's some interesting things that are happening in the markets that I want to talk about. We look at stock markets. So the Dow Jones, for those are not familiar, so the Dow Jones Industrial Average basically is an index that tracks the stock prices for 30 select companies in the United States. These are typically very large companies. These are household names, things like Amazon, Apple, etc. And so the Dow Jones is basically an index that tracks the stock performance and the stock prices of these 30 companies as a group. Now, what we see is, again, the stock market is a popular, albeit weak, indicator of how healthy the economy is. The stock market is on what they call a bull market, which means is running up and increasing in value. People see that as an indicator that the economy is strong. If we're in a bear market, which means prices are going down or staying flat, that means the economy is weak. We're in a weak economy. And what we can see is for the Dow Jones, it was up 3.5% in July and up 7.5% in 2023. Now the historical growth for the Dow Jones, I believe, is 10 or 11%. I have to double check the numbers. So we're on a pretty good track, and you even see kind of the historical data. This is kind of what happened in July, and then year to date, we've had some volatility, but overall we've been on a particular uptrend, especially in the last few months. Now there's another market we can look at called the S&P 500. Now the S&P 500 stands for the Standard & Poor's 500, and this is an index that tracks the largest 500 companies in terms of revenue in the United States. So think of it as kind of an aggregate of the biggest American companies. Again, Amazon and Apple are in there, but there are hundreds of other companies that are in this index, and this kind of tracks their overall performance over time. Now we see that S&P 500 was up 2.7% in July, but look at this. It has been balling out of control, 19.7% this year so far. So we see that we've seen some outrageously good performance from a S&P standpoint. And this has been a great year if you're invested in stocks, because you gained 19% of your money year to date so far, and we're only in July. So we're on quite the streak from a stock market standpoint. So this is the most important part of this update, because there are a lot of reports out there that's telling us how strong the economy is, how much jobs, everybody has jobs. In fact, we're in a labor shortage. So we've got more jobs and we have people who are looking for them, according to the government. We talk about how the CPI is strong, stocks are doing great. People, you've seen, if you have a 401k that's invested in in a reasonable way, you've seen quite a bit of equity and growth in your 401k balances. If you've been watching estimated equities like the Zestimates on Zillow. We've all seen a pretty dramatic increase in equity in our homes in the last few years because of everything that's happening in the market. But none of that crap matters if people feel like they can't afford their lifestyle. All right. So I want to talk about that. The first thing I want to talk about is wage growth. Now, there's been a lot of reporting about, okay, well, yes, inflation's been going up, but wages have been going up as well. And so people are getting paid a lot more than they did prior to the pandemic, even though things are a lot more expensive. And while I would say that's true, when you really look at wages and you take inflation away, so if you adjust our wages for inflation and you say, let's ignore inflation for a minute and just look at what the actual amount of the power of our dollar and where our salaries are, you see that there was a temporary spike in 2020. Again, this is the stimmies, right? That stimmy hit and everything went crazy. But you see that we've basically returned to the same level we were at prior to the pandemic. So when you strip away inflation, what this is showing is that we're not making any more money. What was called the real wages, which is when you adjust for inflation, are actually a little bit lower than they were before the pandemic, right? Now, the nominal wages, the actual amount we're being paid, is higher. But again, when you start to strip away the inflation, you say, okay, if inflation went to zero based on the wages, what would it be? We're actually losing pace. Here's the example that I want to give. And I gave this example in a previous video. So typically in the years from the end of the Great Recession up to the pandemic, you historically would have inflation at around 2.5% year over year and wage growth of about 3% year over year. So if I could give you an analogy, I would say, imagine that you have cars that are driving down the street and wages are driving at 30 miles an hour. Inflation is driving at 25 miles an hour. So if you're in a wage car and you're going 30 and inflation is going 25, you're going to start to create distance, right? You're going to start to drive away from inflation. And so if wages continue to increase at a steady pace, you start to feel like, okay, I got some affordability. The amount of money that I'm earning and bringing in every week is outpacing how much things are increasing in price. So I'm putting a gap on inflation where I feel like life is good and I can afford things, right? What happened during the pandemic was now wages are starting to slow down as compared to inflation. So inflation started to go up to 75, 80, 90 miles an hour, right? 7.5%, 8%, 9%. So now inflation just accelerated out of nowhere, right? But then as things reopened, wages started to go faster too. So wages started going to, 50 and 60. So everybody say, oh, hey, wages were at 30. You're going 30 miles an hour. Now you're going 60 miles an hour. Okay, but inflation is still at 75, right? So inflation is now past us. And even though we're going faster, we can't match the rate of speed. So we were at a point where we felt like we had a gap on inflation and we could afford our lifestyle. But now, even though we're driving a lot faster, inflation is getting away from us. So now it went to, I can afford my life, to there's now this gap in this space that's been created in my life, right? Now, one of the impacts that has is on savings rate. Okay. This is the percentage of income that people are putting into their savings and not spending, the personal savings rate. Now, again, you can see that this hovered around between 5 and 10% in the years following the Great Recession. When the pandemic hit, again, you see this tremendous spike here at the end of the pandemic. Again, that's the stimmies, right? That's because a lot of people put their stimulus checks, deposited them in the bank, couldn't go anywhere, couldn't spend on anything, and they were there. But then what you see is, again, another spike. That was, I believe, the third stimulus that occurred. People putting lots of money in the bank. What you're seeing, though, is after the stimuluses wore off, after people had spent all that money on down payments on cars and wherever else they spent it on, your savings rate started to return back to what it was prior to the pandemic. But now you see that it's dipped down even lower to where it has consistently been below 5% for the last 18 months. right? People just aren't able to save as much as they did prior to the pandemic. In fact, this savings rate is the lowest savings rate since the Great Recession, right? So we can say whatever we want about there not being in a recession, but this savings rate and this affordability crunch, mortgages, it costs twice as much to own a home today than it did 4 years ago. And savings rates are below 5%. This is a psychological recession, right? Forget GDP, forget all those other metrics. The sentiment that Americans have is that I can't afford my life. I'm not able to save money. I'm not able to buy a house. I'm not in a position to better myself. This is bad. Okay. This is when I talk about psychological or emotional recessions, this is what I'm talking about. Let me give you another example. In addition to that, another symptom of getting gapped by inflation or inflation running away from our wages are delinquencies, right? Now, this is the 60 days past due account delinquencies on automobile loans. Now, what this graph shows is that in 2023, the percentage of people who were at least 60 days late paying their car notes is at 1.69%. That's higher than it was at the peak of the Great Recession. Let me say that again. The percentage of people who are at least 2 months behind on their car loans is more than it was during the Great Recession when we had 10% unemployment. We've got record low unemployment. We have more people with jobs now than we've ever had in the history of this country. And yet the default rate on auto loans is higher than it was when there was 10%, when unemployment was almost triple what it is today. I just want you to let that sink in for a minute, right? I don't care about GDP. This signals recession to me. This signals despair. This signals people being in trouble, people not being able to afford their lifestyles, right? Let's take another one. Credit cards, right? Now we see the delinquency rates were hovering around 2.5% prior to the pandemic. Pandemic happened. Again, the stimmies hit. People say, okay, I'm gonna go ahead and pay off my credit cards, right? They got caught up, right? Was in a pretty good spot, especially after that second stimmy hit in 2021. But now, as you can see, credit card rates are starting to return back to where they were prior to the pandemic, even in record unemployment. So my point that I'm making is this. When Americans start to feel like they can no longer afford their lifestyle, when they're saying, look, my wages are back here, inflation's out here. I don't make enough money to afford the things that I can buy. The typical response for Americans is not, well, let me figure out how to cut back my lifestyle so that I can, kind of bring the car back to me a little bit. The typical response for Americans is, I need to take out more debt. I need to borrow more and leverage myself into trying to catch up to that car, right? And for me, that's kind of like, if you remember Knight Rider, he hit that turbo boost button, right? The turbo boost, okay, it makes you go faster, but it's got a limited range to it. You're only going to be able to borrow your way into affording your lifestyle for so long before things come crashing down. Colonel Buckshot, you make a great point here. Student loan repayments. I haven't even covered that in this particular presentation that I'm doing. But, student loan repayments, again, they're, $1.7 trillion of student loan debt that exists out there. I believe it's, over 1 million people have student loan debt. Millions of people are in student loan debt. And they've been in forbearance in some cases for, 2, 3, 5, 7, 8, 10 years. That forbearance is coming to an end. And if people have to start making those $200, $300, $500, $800,000 student loan payments, their wages aren't magically just going to increase by $1,000 to afford those payments. They got to find that money from somewhere. And the other thing to really note, if for those of you who have student loans, you're not aware, you can't bankrupt their student loans away. They're unbankruptable. You can't just say, oh, okay, I'll just file bankruptcy and, I'll just get it wiped out. No, you can't. You cannot bankrupt it out. You only get out of student loans through disability or death, or if you sign up for a forgiveness program where you work in some type of public sector for a specified number of years. So it's basically debt bondage in a way. But I do know I have a personal friend of mine who did work in a particular public sector for the government, signed up for student loan forgiveness, and actually is getting his student loans forgiven because he did 10 years of service working for the government. So there are programs out there that are going to help. The reality is, how many of these people are going to be eligible for those programs? We even really know about them to be able to take advantage of it. And if they don't, how are they going to be able to manage that? Right. So we're in a debt crisis. There's no doubt about it. All of the data that I'm presenting to you is showing that people are leveraging debt to try to keep up with their lifestyles. And unless something drastic happens, we're going to see more people default. We're going to see more people get their cars repossessed. We're going to see people fall into credit card debt. We're going to see credit scores take a huge hit. I don't think we're going to see a huge wave of foreclosures yet, because people who own homes, they have such a strong equity position that they're going to be able to do refinancing fairly easily. The problem is, because of where interest rates are now, that's only going to have a short runway on it as well, because once you start paying those higher mortgage rates or interest rates from that refinancing, first of all, you're resetting the term. So if you, like, for example, I have 18 years left to pay on my home, right? I refinanced a 20-year fix back when interest rates were, really low. I've got 18 years left on my mortgage. If I were to go out and refinance today at a 30-year term, well, I'm now extending the amount of time I need to pay on my house by additional 12 years. So, I was planning on retiring in 18 years. Like, when the house is paid off, I'm retiring, right, in my 60s. Well, if I take out a 30-year loan today, well, I'm going to be in my 70s now. I've got to extend my window for retirement to be able to pay for that. And, when you're taking out debt, you're borrowing money from your future to pay your lifestyle today. And if people, it's going to be a world of hurt for people that fall into all of the traps that are being set to them from an affordability standpoint. All right. So I threw a lot of data at you. I've kind of done some of my analysis in here, but I want to kind of put a bow on some things, just to make it easy for you to kind of summarize what's going on. So the economy's strong, right? Financial markets are booming. I showed you, S&P's up almost 20% year over year. We're in a bull market. Stocks are doing great, right? Unemployment is historically low because we're still in a labor shortage, right? So employment numbers are great. Everybody wants jobs, has jobs. Stock market's doing great. GDP's in the black, right? We're a positive GDP. We're able to produce goods. We're able to do that. We're doing great, right? Now, these are all green lights for the Federal Reserve, right? I'm going to talk about that in my predictions here in a minute. Fed's like I mentioned, okay, low unemployment, good GDP, financial market strong. All right, that means that, the economy can handle us hitting it a little bit harder, right? In fact, the economy's too hot, right? Remember that video I talked about? Economy is too hot, baby. Got to sell some assets, got to raise interest rates, right? The Fed is going to continue to attack inflation because it sees that the economy is strong enough to handle it. Again, what I talked about is the Fed wants inflation rate to be lower than the unemployment rate. Unemployment is at under 4%, 3.6%. Core inflation is at 5%. The Fed is trying to get the inflation rate to go lower than the unemployment rate, right? Having a very difficult time doing that, right? Other thing, this is very important. We're hearing a lot about AI, and AI is they took our jobs, right? AI is taking people's jobs. I would argue, at least what we're seeing now, companies have learned, okay, we're in a labor shortage. Think about this for a second. We're in a labor shortage. Participation rate is much lower than it was 4 years ago, which means there's fewer people in the workforce now than there were when the pandemic started, right? By a percentage. However, GDP has been consistently going up. Companies are growing. S&P is booming out of control. What that tells us is these big corporations especially have learned how to make money with fewer people, right? They are learning how to do more with less. And they're going to continue to leverage that because, again, they've been having to cope with the labor shortage. They figured out, even in the midst of a labor shortage, how they can continue to grow their companies and to grow their profits and produce more work, right? So these companies have been leveraging AI to help to stem the tide from a labor shortage standpoint. And we're only going to see greater investments in that moving into the future to further close that gap, right? They're figuring out how to work with fewer people, right? That's really important for us to kind of key in on, right? You said it, Colonel Buckshot, companies have learned how to work with less payroll. They figured out a strategy and they're going to continue down that path. Now, what's the Fed going to do? Well, the inflation target is still 2%. Jerome Powell is still saying we're trying to get to a 2% point. They're not anywhere close from a core inflation standpoint. So we're going to see more rate hikes, right? We're going to see the Fed continue to boost up that interest rate to try to get inflation down because they see that, okay, the economy is like a runaway freight train. We can't slow it down. We're going to continue to boost these rate hikes. We're going to continue to see that. Now, to wrap all of this up, right? I've been talking for almost an hour, and I want to thank all of you who have been watching. Colonel Buckshot, especially, you're the real MVP. You've been sticking with me the whole time. I really appreciate that. And all of you who are watching, greatly appreciate that. Again, this is my first live stream, so I'm still trying to figure out how to see who all's in the chat and so forth. But it is what it is. I'll look at it later. I'm also, after this live stream is over, I'm going to go back and put timestamps based on each category that I went through, so that those of you who are watching it afterward, you'll be able to kind of, see or jump to certain topics that I covered. In conclusion, I was wrong. Okay. I made a prediction a few months ago in a previous video that we would start to see a downturn in the economy as soon as the summer of this year. I was clearly wrong. Okay. We're not seeing a slowdown this summer from an economic standpoint. I really underestimated how effectively big corporations are learning how to do more with less. I really underestimated that. Now, in the previous video, I talked about the May economic report where it says that hundreds of thousands of jobs were added, but unemployment went up. And I said the reason why that happened, or the reason why those two things can be true, even though they seem to be contradictory, is that major corporations are swallowing the gig economy. So there's more payroll W-2 jobs that are out there on the market that are being filled, but they're doing that at the expense of the 1099 or the gig economy type jobs. Small businesses are really suffering because, again, it's very difficult and expensive to borrow money. So if you're a small business and you need capital to grow your business, it's very difficult for you to get access to it right now. If you're a 1099 worker, Uber driver, things of that nature, the cost of fuel, the cost of you being able to run your business are exploding so much out of control at a much faster rate. And at the same time, particularly with ride sharing and delivery, you're seeing an actual decrease in the profit shares that the company's sharing with you. So your income or profit share is going down while your costs are exploding. So it's much more difficult for you to do a type of gig economy or ride sharing type business. I also underestimated what I'm calling the debt determination. In other words, how committed Americans in general are at using debt to maintain their lifestyles. I really underestimated that. I really thought that there would be more of a pushback in terms of people being more insistent upon saving instead of spending and making the lifestyle changes. But it just proves that people in general are sheep, and they're going to continue to fall into the traps that's given to them and feed into the lies that the government's telling them. But I want to tell y'all, winter's coming. Okay. Now, I'm not predicting an economic recession this winter. I think that the runaway train that the GDP and the stock market is on, I think we're going to continue to see that roll right into wintertime. So I'm not predicting that we're going to see a recession from an economic standpoint. What we are going to see, though, is, again, higher rates. The Fed is going to jack up those interest rates out of control. Until core inflation is under 3%, we're not going to we're not going to see anything lower. Colonel Buckshot, I'm hear you. Fat back and fried taters. My wife told me she's making spaghetti tomorrow, and I love spaghetti, but Desperate times, brother. Desperate times. But so going back to higher rates, we're going to see these rates go higher and higher. That means that mortgages are going to become more difficult to get because, mortgage rates, we're going to 10%. I'm telling y'all right now, they're already above 8, depending on what reports you're looking at. Your typical 30-year fix is almost at 8 now. We're going to be at 10%. We're going to be at 10% by Christmas. The Fed's not slowing down. You're going to see more defaults, right? Default rates are going to get out of control. People are not going to be able to keep up with their lifestyles. The bow is going to break and the baby will fall. We're going to see more of that. Holiday retail is going to take a hit. I know there was a lot of doom and gloom about Black Friday last year. I think that we're going to see even a worse bloodbath this holiday season than we did last season, because again, people are not going to be able to sustain their lifestyles, and we're going to see a major contraction in consumerism in the holiday season. I think we're going to see more, unfortunately, we're going to see more small businesses take big hits because they're always the most fragile and the first ones to be impacted when there's any type of downturn or any type of disruption in the economy. It's going to get a little harder for a lot of you small business owners in the coming months because money's going to be harder to get and you're going to see a decrease in demand, right? We're going to see layoffs. Now, it's unknown whether we're going to see a stabilization in labor shortage by the time those layoffs come. And there have been, as I reported earlier, we've seen like tens of thousands of layoff jobs announced over the last 6 months. But even though one company is laying off, there's so much hiring happening in other companies and other sectors of the same company that those people are able to fairly easily find work elsewhere and they're able to find work elsewhere. So they're not staying on unemployment very long. Is there any good news? You always talk about, hey, do we have good news? What's the good news? I think there's a couple of things we can take away from this. Like Graham Stephan says, how can we use this to make you money, right? Let's see if I can help you make your money. I want to point out, because we are in an unusual period where interest rates are being jacked up out of control by the Fed, that makes it an excellent time to create a cash position in T-bills. So these are your treasury bills, your treasury bonds. They're at very high interest rates right now. This is a good time for you to get an understanding of how they work and create a cash position for yourself if you believe that those bonds are good for you. It's kind of a semi-liquid way to invest your cash, because CPI is still eating into our cash dollar, but we're reaching a point where interest rates on certain treasury bonds are actually outpacing inflation right now. So that is that can be a good place to park your money. It's important though that you understand how they work and work with a financial advisor to determine if that is a right option for you. The other thing, this is something that I personally have, is called high yield savings accounts. I just got an update from my bank where I have my high yield savings accounts, where they've raised interest rates up to 4.15. And so this is a great time for you to have, building up an emergency fund and putting money away in a high yield savings account. This is 100% liquid. Most accounts will have some type of minimum requirement. They may say you need a minimum balance of 3,000 or 5,000. Some of them don't have any minimum balances at all. So if you're in an opportunity, you're looking for a way to kind of protect your cash and kind of shield yourself somewhat from inflation, I would encourage you to do some research around high yield savings accounts. Again, talk to your financial advisor and figure out if that's a right option for you. I can't imagine any financial advisor telling you not to save money. That doesn't seem like it makes sense to me, but everybody's situation is unique. So it's important for you to look into these things, but the Fed is trying to encourage people to take money out of the system and save it. They want people to save more and spend less because that's what's going to drive inflation down. This is a good time for you to start parking your money into some of these instruments that have higher savings. I think we're also going to see more slashes in prices on homes and autos. Home prices, sell prices for homes are going to continue to go down. When these interest rates go to 10%, all of these stubborn sellers are not going to have any choice but to push the bailout button and start doing this. Also, we're continuing to see new homes being built. Builders aren't slowing down. So there's going to be a lot more new homes that are going to be put onto the market. Again, there are hundreds of different housing markets. Based on where you live, you may be more or less affected by that. Generally speaking, the Northeast, there's not a whole lot of home buying. So you may not see as much volatility from a pricing standpoint there. Where I live in Florida, we absolutely will see a lot of volatility in a lot of the markets in Florida because there's so much building here. Again, all of these baby boomers are retiring and moving here. Texas is another place where you're going to see a lot of boom from a construction standpoint. So we're going to continue to see those prices come down because the builders have to sell those homes. The builders are not like these sellers that have been in their house for 25 years and have, $300,000 in equity. The builders don't have any equity in these homes, right? They've spent billions of dollars building these subdivisions. They have to get these off the books. They have to get these homes sold. And in some cases, the reports I'm starting to hear is in some markets, the prices for the new homes are lower than the prices for the existing homes that are in a similar neighborhood and similar size. These builders are going to start getting desperate. They're going to have to offload these homes, which means they're going to have to drive the prices down. Same thing for the car market. Repossessions are starting to return back to their pre-pandemic rates. So the number of cars that are going to be shoved into the market is going to continue to increase. And repos are only going to get worse the higher interest rates go and the more the people can't afford their cars. We're going to start to see an uptick. We've already seen that the supply chain for new cars is stabilizing back to where it was. So there's going to be a steady flow of new cars. Again, we're entering a new model year. The new 2024s are coming out. So there's going to be a ton of inventory sitting on car lots over the coming months. We're going to continue to see decreases in prices. But let's be realistic. They're never going to go back to the way they are, right? In terms of auto prices and home prices, y'all, we've crossed the Rubicon, right? It's not going to go back to the way that it was. We're in a new normal now. However, I do think that we're going to see more favorable pricing going into the winter in terms of not only the inventory for homes and cars I talked about, but also from a seasonality standpoint, the winter months are the slowest months for buying a car and buying a house. So you're going to see better prices in the winter for these things than you did during the summer. Partially, again, because of seasonality, but also because inventory is going to start flipping in the favor of buyers. All right. So that's the end of the presentation. Thank y'all so much for coming out. I have no idea how many people are watching. I know at least Colonel Buckshot is watching. So at least one person is watching. Really appreciate it. Again, I had no idea what I was doing. I was on mute the first 3 minutes of it because I didn't have my setup working properly. But I really appreciate all of you for watching, helping me support the channel. Please make sure you hit that like button. Subscribe to the channel. Really helps me out. I really want to start monetizing this channel and growing it to a point where I can keep up with my lifestyle. All right. Thanks, everybody. Until next time. And we're going to be continuing our series on Dave Ramsey's Wrong About Everything. So stay tuned for that. I'm going to be releasing another video about that soon. Let me know in the comments what you thought of this show. Did you like it? Did you not like it? Were there things where you thought I was wrong? Were there certain things or topics that you want me to cover next time? I want to try to do these once a month. So are there specific topics that you want me to cover next time? Are there numbers you felt like I got wrong? Let me know in the comments. I want to hear your feedback, and I do read your comments, and I want to make this show better the next time we do it next month. So please give me your feedback. Thank you so much for your support.